Greetings, everybody. This is Jeff Scott. It's still the first, although it's titled the second. Usually I spend the hours on Saturday and do them on Sunday, but I'm about to head out to a concert tonight. And then tomorrow I've got a little football game I'm going to attend. Since I live down in South Florida, it would be a miss. And my partner of 21 years bought 2 boxes to take all his friends, which isn't a bad deal for being a friend. My title today, Worldwide Markets Catch a Cold. And my name is Jeffrey Scott. My email is hgsidoc@gmail.com. I've been doing these for decades. I try and do them every Sunday when available. Some of these I'll do live. I'm planning on a live one, meeting with audience in the next week or 10 days. That will follow an invite. Probably do a quick YouTube video to push that out. And I am probably more of a bull, and certainly not a perma bear, so that probably will reflect some of my commentary. The disclaimer: this is for educational purposes only. Anything I recommend is in the spirit of education and not investment advice. I am a doctor, not a broker. I am independent. I have paid for my tools. I do not take any advertising or money that might bias my comments. I speak a lot about the tools that I use, including HGSI and John Person's indicators, because that's what I use. And I make a lot of money trading, and I have been for a number of years. Trading involves risk. You and your loan are solely responsible for any investment decisions you make. I always do like to call out where my learnings came from. I started as a CanSlim follower. This was certainly improved by Morales and Catcher. Ian Woodward had his own flair that he added to it. George Lee, one of my favorite trading buddies, lives out in Canada. We get to share the podium fairly often. Van Tharp, the king of position size and money management, never went to his live meetings, but I've read his books. Cigar from Superior Profit. He's got some great tools that I use on a regular basis. And then my buddy John Person, who we'll talk a lot about today, a trader, teacher, mentor, friend, developer of some great indicators, and we'll have the first about to launch paid, 4-letter word, paid add-on for HGSI. I own a lot of tools. If you see my desktop, you'll see them. But most of the time I spend in TradeStation and Thinkorswim with my various indicator packages, HGSI for analytics during and after market hours, EdgeRater, and then a sundry of other products, including Sagar's Superior Profit.co products. If you don't have HGSI, I highly suggest you try it. I do, as much as I love the program, I do feel that there is a steep learning curve, but, I couldn't go fly a rocket ship on my first attempt, and this has got that kind of power. If you do download HGSI or you're struggling to figure out how to make it work for you, I have put together some videos over the past several years, and I'll be updating those of how I use HGSI with the new add-on coming. If you email me at hgsidoc@gmail.com with specific ask, I'll see if I can't share some things with you. Stock patterns are cyclical. Now it feels like we've rolled over. Are we in stage 4 fear? Or is this going to be like the last decade where as soon as it feels like we're done going up and we're about to crater, we get another leg up? I think that's what's going to happen. I think we're still in a longer term bull market. I'll show you some evidence from me and a very smart advisor who I follow that supports it. But that doesn't mean I'm moving student body left and just going all in. I have to trade the market I got, not the market I think I have. And as you'll hear later, I've added to my volatility instruments. I've bought more gold. I've rolled my options up and out, and I've taken a lot of profits so far. So I'm going to call us confused. We might be entering a down cycle, in which case I'll be buying more puts, selling calls, shorting stock, and buying contras. I have started to nibble there. But since I'm still confused or uncertain, I have raised cash and have sold some premium on my positions. Friday was a horrible day in the market. I actually made money on Friday, but that's because I have Amazon and a lot of it. But most of my positions were down, and I did take some off the table just in case this is the beginning of something that goes on a lot longer than I might think it will. Speaking of how bad Friday was, you can see what Ian would call a sea of red with some very little positive marks, and you can't even see a sector, and the sectors start over here with metals, where a sector, S&P sector, was positive. Major markets, let's go look at them in think or swim. I'll make a comment about how I've done this year to date. I don't always share my numbers, but since I called out, I'll tell you I'm up about 30% in the year between this and a much smaller trading account. The number you should always look at when you listen to a teacher or somebody, this is the number that tells you whether they're making money or not. Not how many profits they have left in their positions, not what they did today, nor what's in their sweep value. My balance will go up and down because I use this to live on and write checks and things like that and pay credit cards. But this is a number that's dependent upon one thing, and it's how much money I make in the market. Only put that there because why would you listen to somebody who starts by saying, I don't make money in the market and I'm going to teach you how to lose? That's nonsense. And once I listened to and I won't say the name, he's a pretty widely listened to guy, and he talked about how he blew up his account and some of his users' accounts and apologized. I mean, it's nice to apologize, but I hope I'm not paying money for somebody to blow up my accounts. That said, I want to look at the major markets and not talk about my portfolio and my long and short holdings that are there. This are futures. When I get into HGSI, we'll be looking at the cash market and the indexes. I like the futures because they capture what happens after hours, and sometimes they give a better, to me, reflection of the market. So as I look at the E-mini dailies, clearly from the lower left to the upper right, we're in the midst of a very nice uptrend. We peaked for the past 52 weeks or 365 days or 250 trading days, whatever they are, back here on January 26th, I think. Sometimes I can't even read my own stuff. And more importantly, we are just a modest amount off the high. So as bad as it felt Friday, you think about it, 1, 2, 3. We had a bad day a week ago Friday, and we talked about how the market likely was going to go down and test. We had a horrible day Monday. Then we moved up for 3 days for the most part, and we came down and tested that 50-day moving average on Friday. This could be a reasonable reversal zone. Look at the volume that came in on Friday. And it could also be just a stop on the way down to the 200. So this is something, it did pull to that 50 and bounce, so we'll continue to watch that. If I look at the NASDAQ, a similar pattern, although much higher than the 50-day moving average, and it too, around the 26th, set its highs for the last 52 weeks. Is it still in an uptrend? Yeah, I mean, it depends on your time frame. If it's Friday, no. But if you look at it over a period of time, it's still in an uptrend. Also, big volume on Friday. The Dow futures, they look a little different, don't they? And that's because they've undercut their 50. So I've got the S&P that pulled down to the 50 and bounced. I've got the NASDAQ futures that are hovering well above the 50. And I've got the Dow futures that knifed through. So you got three different pictures, and we'll talk more about the high, low, and middle road scenario. Certainly there's risk, and its high of its last year was back a couple weeks ago. If I look at the Russell, and I use the I'm going to switch to the RTY here. Let me just check one thing here. I'm going to go. All right. I'd switch to the Russell futures because there was a change in to the Russell ETF because there's a change in the futures. But we've got to have enough data that I can go back and look at the RTY. And you could see that even more so than the Dow, the Russell futures have really undercut and pummeled below the 50 again on their way to the 200. I did look at gains in the, when you look at the gain from the third quarter, fourth quarter to the highs, the Russell actually outperformed. Now, if the markets are selling off, then the VIX popped, and it did. Now, the VIX, is this the beginning of a new run? In which case, those VIX instruments that I purchased, such as VXX, will protect me from a fall, or are we going to peak early on Monday and come back down? That's why I buy protection. Unfortunately, I probably lose about 10% of my gains a year in protection. But if I can get outsized gains and sleep at night and not worry about the big one, and I lived through 2007, 8, and 9 to talk about it, I'm willing to pay for insurance. I do for disability and life. Why not for my stocks? But, at some point, this VIX is going to reverse and come down, and you're going to want to go long then. So the VIX has already had a pretty big move. Again, is this the end of the move like we've seen back several times? Or do we have a little bit more follow through? We'll see what happens this week. And the dollar, which was strengthening and hurting the metals, sold off the last couple of days. So that's the daily charts. Now I could do the exact same review on the weekly charts, but to save time, I'm going to go back into the PowerPoint. And yes, PowerPoint's not as good as doing it live, but these are just snapshots I've taken today just to speed things up. When you look at the weekly, I think it's really easy to see the long-term uptrends that the three majors, E-minis, NASDAQ futures, and Dow futures have been in, how the Russell has yet to take out its prior highs from 2018. I believe that's 2018, if I remember correctly. And how the VIX is up this week, but still not nearly as high as it potentially can go. And the dollar is struggling here and is sort of going sideways. Now, some of the things that I saw underneath. This is a picture in white of the 10-year Treasury yield. On the right, the 30-year. In yellow is the S&P 500. The lines that are there are lines that I've put in a long time ago. And those lines are sort of, they're important lines to me because when I break down below the second line here on the left, is typically when I get nervous about the economy and the market might be giving us a signal that there's problems. When I go above this line, the rates start to become a problem and I worry about the market slowing down. Here, when I'm broken down below this lower line here, which is analogous to the second line on the TNX, that tells me this economy's got some fear, and that's a problem. Because low rates are great as long as it supports growth, but when the rates tank because there's concerns about growth, that's not a good sign. Now, falling rates are good for REITs, MLPs, utilities, dividend payers, and home builders. I can tell you on my bottoms-up review of hundreds of stocks today, lots of REITs, lots of utilities and dividend payers, not a lot of home builders, nor anything in the energy complex. Now, I also commented, and it's hard to see here, but you have to trust me that it's fallen from here down to here, that the spread between the 2 and the 10-year, which I think are the official, if you look at inversions, are getting closer and closer to where they were several months ago when people were talking about inversion and recession. Let's hope we get a quick pop out of that, or else the talking heads will be back on the recession road. If I look at AD lines, you can see that the Russell 2000 and the Russell 1000 AD lines turned down, as have their corresponding indexes. If I look at the NYSE, now I don't see divergence there. The only divergence I see is this light blue, and it's really divergence that I look for where the prices are going up and the AD line is falling. The divergence I see is the blue because that's bonds, and as interest rates have fallen, bonds will continue to go higher. What about breadth? Stocks above the 200-day moving average on the left, above the 40-day moving average on the right, both came down hard. Now, these may not be approaching oversold, but when I look at the 3-month new high, new low ratio, we are getting very close to points of reversal, and this has been an area, a zone of reversal in the past. But I guess if you look back here, the 2018 major pullback in the market, some of the earlier ones, you can get a little bit more oversold. But this is a signal that says be leery and be aware that you might get a bounce in the next few days. The daily McClellan, the weekly McClellan, not much to say, but the divergences that were concerned us has played out in a market sell-off. The buckets are interesting. If we go in the lower left-hand corner, a week ago at 17% of stocks below the lower band of the Bollinger Band here, the lower band of the Bollinger Bands on the S&P 1500 individual stocks, 16% were below on Friday a week ago. Until last weekend, I said we'll bounce soon, but we might get worse. On Monday, we sold off, and oh no, I did the same thing twice. All right, take my word for it. Actually, don't take my word for it. Hold up, I'm going to be right back. Okay, so I'm just going to show you the numerical number. And you can see how big the spreadsheet is. It's got 5,000 lines. If I look at a week ago, I said there was about 16% of the stocks in the S&P 1500. So 16 plus 8 is 24. So 240 stocks were below their Bollinger Band. And as I said, that shows me that we're probably going to correct soon, or reverse soon, I should say. On Monday, we were up to 420 stocks that were below the lower band on their Bollinger Bands. And if you think about it, if 27% of the stocks in the S&P 1500 are trading below their Bollinger Bands, and stocks spend probably only 5% of their time during the year below the band, what's likely to happen within the next few days? What's likely to happen is they're going to come back in. And we saw that until it reversed again on Friday. And on Friday, we got back to that number, don't save, here of 30% of the stocks below the Bollinger Band. That's a place we're in a bull market. Historically, I've seen us reverse. Now, are we still in a bull market? We had a small correction. I'm going to say yes, we're still in a bull market. HINDYs. Now, one of my friends who I just started doing some mentoring for pointed out on Thursday or Friday that, hey, we had a HINDY, and we did on both the NASDAQ and the NYSE. On Monday, we had a Hindenburg Omen, and we had follow through on Thursday and Friday. This is a sign that if you want to be bearish and start preparing for another 10% correction, you can use that as a good reason to. There hasn't been a bad correction in over 50 years without this signal firing. The problem with the signal is often the corrections are just a couple of percent. So I'm not saying because of that to sell everything. I'm just saying raise your awareness. Now we had two volleys of kahunas to the downside, which is a volatile move. A light kahuna is a percent B change down more than 0.24, and a dark red would be 0.4. And we saw every index on Friday and on Monday give us shots across the bow. And that was enough to convert over here in the Woody indicator most of the major indices to a bearish formation. If I look at the sectors, they've also weakened. I have to pay attention to this, Jeffrey. Some of these are, I forget, deteriorates. And I'm afraid if I don't change it, then somebody may be fooled. The only thing that's holding up green is utilities. Not a big surprise considering, considering the interest rates that they pay and the defensive nature. Staples and real estate gave up some of theirs this week. Now, a little bullish tone. Canaries in the coal mine, clearly supported by Amazon. But as I think about it, Tesla had great earnings, Apple had great earnings, Netflix surprised to the upside. Facebook gave back a lot. Haven't seen Baidu yet. And as I look at this, this is a synthetic index created from those stocks back in 2013. We're at all-time highs. Now, we gave back some on Friday. We're at all-time highs. So how bearish do you want to be at all-time highs? Now, thinking that we were about to top, or should be topping soon, based upon history, I decided to put together an index of leading stocks back on January 19th. This is a tool that was taught to us by Ian. These are the stocks that I chose, no more than 2 per industry group. And you could see how beautiful the line of this index was. Now, we got hit hard on Friday as momentum and leaders rolled over. And you could see my indicator, which is now will be replaced by John's indicator, which will have a signal. I think the underlying has been replaced, just not the name. You had a kahuna to the downside, out of a squeeze, and the Hindenburgs. Clearly a very bad day for this index. Yet, still well above the 50-day moving average, which we call free parking, because we know that great stocks will often come back and touch that 50-day moving average and will continue to move up. So far, I'm not too worried about this. Crossing my fingers. This is not necessarily the end, although it certainly could be. Now, this week, from a news perspective, everything's going to be right down here to the unemployment rate and non-farm payrolls and average hourly earnings. We had some negative data this week. PMIs and other things, sentiment were negative. Not PMI, but sentiment was negative. So we've got some PMIs this week, some construction, ADP employment, weekly jobless claims, but I think a lot's going to be non-farm payrolls. Everybody now is going to be concerned, in my opinion, with several things. One, the inversion of the yield rate. Number two, how broadly will, and I'm going to talk about coronavirus, but how broadly will that impact on the economy of China and bleed over to the rest of the world? And then, does the Fed really have anything left to support the market? So it's going to be an interesting market week. Earnings whispers. Oh, yeah, by the way, tons of earnings this week. The reason why I haven't seen Alphabet's yet is because they're not out yet. So Alphabet's on Monday afternoon. But you can look through these, and I suspect you own several of these stocks. I know that I do, and I will probably take profits on several of them prior to the earnings coming out. Now, this is one of my favorite sayings. Yes, I developed it. I'm not saying that others haven't thought of it. It's a judgment call to hold stocks over an earnings date. It is bad judgment to not know when your stock's earnings date is scheduled. Thoughts on coronavirus. I am a physician. I have been in the healthcare, in one shape or another for almost 40 years. I think this hysteria with coronavirus seems overdone. As of right now, you've got 7 Americans, 1 transmission from husband to wife, no deaths in the U.S., and 174 awaiting test results. So those are the numbers. I'm sure they're worse today than those statistics, but I'm not sure by how much. If you go to Wuhan, it has a population of 11 million in China. Now, China is reporting 11,000 cases. One of my friends has folks that he knows there, and they're reporting about 1% of the population's infected. And as you can see, 259 deaths in China. That might be actually worldwide. R equals 4. That means every person infected is likely to infect 4 more people. Well, if it is true that you can infect people before you even know you're sick, then this thing has a long ways to run. And that's why I think you're seeing the World Health, the CDC, and others react aggressively on isolation. And probably is why the markets are so skitty because of it. It's spread by droplets. Those droplets, unlike SARS and others that may go over a long period of distance, they're usually limited to very close proximity. Now, as my wife likes to remind me, and what we were reminded by the nurses, wash your hands, don't be touching your face, and stay out of areas where you see people coughing and sniffling, although I remind you there's influenza season and viruses, and right now there's 12,000 cases in the world and 259 deaths. Now, I don't want to be non-sympathetic to the left. Just take a look at the numbers on the right. There was an epidemic of influenza in the U.S. in 2017, 18, and 19. There were 80 million infected Americans and 95,000 deaths from the flu. And if you were older than 65, your mortality rate was 10%. For this flu season, they're expecting upwards of 26,000 patients to be affected and up to 26 million rather, and 25,000 deaths. So yeah, everybody's concerned about coronavirus because of what we don't know. How is it going to impact on the Chinese economy? Is it going to spread everywhere? Is it going to become like contagion, an outbreak on TV? Or is it going to be like the last several epidemics and disappear? Be leery. Every one of those epidemics, you've seen stocks like Alpha Protec and Lakeland Industries, who make gowns and masks, go up very far and come down just as hard. This year seems to be those and the antiviral stocks. Again, be careful, because by the time they get drugs or vaccines, if this is like any other viral epidemic, it'll be gone before those are done. And oh, by the way, the most important thing you can be doing, which has nothing to do with coronavirus, is getting your influenza vaccine. Now, this is in Market Watch. How has the market performed during past viral outbreaks as coronavirus infected 7,700? This was on the 30th. Lists some of the major epidemics. I took the ones that I've been around through that resonated with me: MERS, SARS, Ebola, swine flu, pneumonic plague. I could have put avian flu as well. And here's some of the take-home messages. Number one, if I take the biggest drop that occurred in the first couple of months of the reporting of the epidemic, the largest drops were less than 7%. The time to those largest drops were up to 26 days. But 3 of them the drop occurred immediately, and then the markets went on. In each case, averaging about 13%, the markets were up in 6 months, and averaging 25% in 12 months, despite things like Ebola that saw in 2014 epidemic 11,000 worldwide deaths with a 50% mortality. So, yes, let's be concerned, let's be worried, but you'd be better off not worrying about it and going and getting a flu vaccine. Enough of that, I guess. I think it's important, as bearish sounding everybody on TV is right now, do not rule out a continued bull market. I was going to reproduce some of this. This guy, Hgsi Capital Management, is brilliant. He comes out with a weekly YouTube. I follow it religiously. He's got a blog. There's his website. He also manages money. I think his minimum is $400,000 or $500,000. He has a unique approach to a market model. super smart. So he's been pushing the idea that the longer a market goes sideways, the bigger the move you get once you break out of that sideways market. He's one of the guys that sees us being in a secular bull market here, and that's similar to the market in the 50s and 60s, 80s and 90s. We have a market that could go on quite a bit further. He uses a lot of data to support this. Got me convinced. As I said, I think he's brilliant. He does point out that it's not unusual to see fairly ferocious pullbacks, even in a period of a great uptrend. He likes to identify, I think they're obscure, but as I said, he's brilliant, findings. So this week, he talked about the performance of the NASDAQ versus diversified bonds. And basically, you can build a spread chart, stockcharts.com. You can also build it in Hgsi. And he's using the Vanguard Bond Index Fund because it's been available for a long time. And then they put a 75 and a 200 daily moving average on them. And then he pointed out a period of time on the left, culminating in the end of August of 16, at a time in December of 2019 where you had an inversion with the short term crossing under the longer term, and then back to the short term on top of the long term on these two dates. He then pointed out the long period of time and the big uptrend that occurred after this occurred, and he identified a second period anomaly, which is what happens when you take out the prior peak. So then he presented the data for these. I tell you, his videos are great. He went back since 1991. He found several occurrences, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 12 occurrences following this bullish cross on the spread chart of NASDAQ versus bonds, so NASDAQ outperforming bonds. And what this chart here on the right tells you is when this has occurred in the past, and it just occurred in December, whether one looks at 3, 6, 9 months, 12, or 24 months, overwhelmingly the market is up. And you could see the number of years that's positive on the bottom, and then the median and average returns. Not necessarily humongous returns, but nearly uniform positive returns. If you include the second part where it took out that prior peak, the numbers get even more impressive and even higher. So this has just occurred, and he's got at least 8 other stories of things he looks at, many of which I've incorporated in my models, that help him predict longer term. No guarantee. Past performances do not guarantee future results. But to me, this is important to know. And then the question comes, but we're having a drawdown now. If it's so bullish, why are we having a drawdown? Well, it turns out drawdowns do occur, and the vast majority of those drawdowns, as you could see, are less than 5%. So he's bullish, and I am too, although I think short term, lots of things can happen in this market. So markets do not go straight up forever. We had 13 out of 15 weeks up, over a 12% move, so everybody was expecting a pullback. They're going to blame coronavirus, but the markets were extended, and multiple signals have suggested taking profits. Now, we had 2, 3 really bad days in the last 6 trading days, and markets have quickly become oversold and are near a level that in bull markets one would expect to bounce. I still believe we are in a bull market. Because of hysteria, HINDYs, etc., I'm cautious. But I'm not ruling out a positive resolution, perhaps as soon as this week. Now, I had a profitable week and ended January up about 500,000. about 30% across my two trading accounts. I showed you the bigger one. Performance was, frankly, in the beginning of the month, everything went up. But the last week with Netflix, Apple, Amazon, DT, I think it's Dynatrace, and Microsoft earnings really propelled my account. I have added to the VXX and gold positions going into the weekend, protected many profits by moving my options up and out, which is a critical part of my trading plan taught to me by John Person. Now, I wanted to mention a comment about up and out, especially since we don't have a whole lot of bullish stocks to look at. I enter trades using options almost all the time instead of stocks. When would I not use an option? When perhaps the volatility is so high that the option's too expensive, but then I'd probably do something where I have multiple options to defer away or spread away some of that extra cost. On a very cheap stock, I won't use options. If something I'm buying for a dividend, I clearly won't use options. I don't usually buy just a call. I usually do a vertical spread, a synthetic stock, which is buying a call and selling a put at the same strike price. A synthetic call, which is my chicken shit synthetic, where I buy a call, sell a put at the same strike price, and sleep easier by buying a put out of the money so that I don't have to worry about a big drop. And I bought butterflies, but I don't usually do them around earnings because you get something like Amazon where you're directionally correct, but you go so far up, your butterfly becomes worthless. As the underlying price rises, I start to close out my short put positions. So if I had a synthetic stock and I'm short either a put or a put spread in a synthetic call, I've got 90% of my profits in it, or it gets down to like 30 cents, 15 cents, take your profits. Why would you want to carry something that goes against you? And that leaves you with a profitable call, most likely. Now, as the price continues to rise, I have a call with growing intrinsic value. That means my delta is rising. I'm getting deeper in the money, and my performance and movement reacts just like a stock. And I have less and less time value. Now, as a beginning option trader, I was so excited because my stock, I would be buying Amazon calls for $4.50. At $4.50, the stock price was over 1,000, and I was just rolling that same $4.50 call because it didn't cost me anything. The problem is, if Amazon dropped down to 500, I had a lot of money at risk. So now I realize that I want to have less intrinsic value so I don't put all my profits at risk. So now I will roll along option up to a higher strike price and out to a later month. Hence the terminology up and out. This protects me by booking profits, although my time value goes up. I will sell options out of the money on long and or short side to help finance the premium. So now I'm still in the position. I put money into my account, and if it goes against me, I have less risk. I do give up delta, but I'll give up delta to keep profits. All right, we're going to do a brief top-down review because I'm not going to show you a whole lot you're going to want to buy. So very quickly, let's jump into my trade station. Sorry about that. And let's just go quickly and look at my major market indexes in the futures just to get a sense of our level of oversold. So we're going to start with the E-minis, and there's several things here that you should notice. Number one is I now have a sell signal on the S&P futures on the daily, and a sell signal, these are John Person PPS sell signals, on the weekly S&P futures. Now, if I quickly go to the spiders, you can see the cash markets did not get the recent buy and the new sell on the daily. They do have the sell on the weekly. So the E-minis clearly are demonstrating weakness. Second thing is the paint bar is red, which is bearish. It tells me I should not be entering long positions. It's blue on the weekly and green on the monthly, which tells me that longer trend we're still strong, but longer term, but shorter and intermediate we're getting weak. Then I look for these red dots. Those told me we had some MACD divergence and sort of predicted, but not great at timing, that the market would roll over, as it did. We are now at the lower part of the auto envelope, which is typically where we start to get excited for a reversal, but we could still get a little lower. The weekly bongo, which is the middle dot here, has stayed green, which is surprising but bullish, while the daily bongo has turned red. And if we look at where we are from an extension perspective, we're down to about 60 on the high jump bar. So seeing that tells me we have no overboughtness that I need to worry about, and we're clearly getting to a place, as seen up here on the envelope, where a bounce might occur. If I look at the Dow futures, in a longer term sell signal, the weekly bongo turned red, the weekly has a sell signal, and we're at 43%. Now, if you don't believe me that this thing works, as we went up, we were at 100, and that was telling you it's time to jump. When you get a high jump of 95 to 100, you're getting the most extended that you've been in the period look back. Mine's 200 days, and typically the market starts to roll over, and it did here like it always does. If I look at the NASDAQ futures, new sell signal here, 69, and at the Russell futures, sell signal near the bottom of the envelope, down to 40. So if you didn't catch me last week, which was an intermediate story, but caught me 2 weeks ago, we've clearly taking a much more bearish appearance on these charts. If I go and I look at the dollar, you can see the dollar's got a new sell signal. If I look at gold, it's in a buy signal, it's in an uptrend, and we'll talk more about it. And at 63, it's not overbought. Now, we're going to move back into the cash markets as we go into Hgsi. This is how I do a top-down review every night of the week, except for Friday and Saturday when I do a bottoms-up as well, and I look at hundreds of stocks. I go into the market analyst user groups, Major Markets Plus, I hit the warehouse view, and it should pop up open here. I then go and I find my top-down view, which is price and volume only, puts more weight on the last day and the last 5 days, so what's moving moves to the top. And when I see treasuries and gold, and silver and gold and utilities at the top of my list, I know that my growth portfolio probably was under some pressure this week. Now, within Hgsi, there's something called a group performance tool. So I run that every weekend, and just to give you a sense of what was working this week and not. Up, here it is. This will take a second to open up. And when you see predominantly red, that should tell you about the market. A couple of key things here. The stocks that I looked at overall in my buy watch last week were down 0.81%. When I do a filtered buy, which are the ones that I do a little bit extra work on with John's stuff, they were up 0.75, they were up 1.08, and my holdings were actually had a good week. We're up 2.5%, but that's because of some of my option, my earnings plays. But you can see on the S&P 500 down over 2%, the IBD weekend review down over 50 or 2%, the IBD 50 down 1.75. So it was not a great week for growth stocks, which is where I usually live, unless the name of your stock was Amazon. So let's look at some things here. I was playing around, so I'm going to have to get to what I usually look at. For those that are wondering, will you have my access to everything I have here and my exact views if you end up purchasing John Person's add-on for HGSI, absolutely. The reason you can't have it now is I've already got his stuff in it, as you will see, especially when I get to the daily stuff. All right, so we're going to start by looking. Let me make this a little bit different here. Here is the S&P 500. And you notice on the cash, it is pulled back into, on the indexes, into the 50-day moving average, and it bounced. We know from the S&P 500, from the we know that from some of the other stuff we saw, the volume, at least on the spiders, was quite high. So, Ian taught us to do a 3-road scenario: high, middle, and low. So let's do that very quickly. We've now established a new box. Probably not going to show up if I don't put a color on it. Notice how this line was support here, and it's an unfilled gap there, whatever that means. I know what it means. I don't know what it's going to do, though. So here is a box that I'm going to look at. Now, scenario number 1 is, hey, this is great. We're at the bottom of the box. We're going up. That would be the bullish scenario. Scenario number 3, the bearish scenario, is we're going down. Now, of course, as we've talked about before, that doesn't mean a straight line. It could mean something like this. Or we're going to go something neutral. We'll do that one in blue. And neutral might mean that we're going to bounce around here for a while before we decide where we're going to go. My guess is we're going to bounce around here for a while, and I'd be looking for a break out of the box on top or a break below for me to commit massive amounts of money one way or the other. This end of the week hurt. Most people and most portfolios lost money. I'm going to put a little bit of bullish on this bounce off the 50. Here's the Hindenburg. We've come off of overbought with a high jump. On the weekend, not a whole lot, or the weekly, not a whole lot to say there. If I go and look at the Dow Jones Industrial Average, broke through the 50 and is now coming down to what was prior resistance. If I look at the NASDAQ, we're sitting up above the 50, actually, with much better appearing pattern. Or much worse because it's got a longer way to fall. The Russell, which has been the weakest over the last couple of days, just to give you a sense of how much that Russell moved. If I go from this low here up to the high before it turned around, the Russell was up 17% in 73 days. How far have we fallen? This is the worst, and we've fallen 6%. We're about half that on the S&P and the Dow. So this is the weakest. The Hindenburg is worrisome. I don't see anything bullish there. If I look at the dollar, as I said, the dollar has weakened, failed at the 50. We've got a death cross here with the 50 crossing below the 200, suggesting to me that the dollar may continue to go lower. If I look at volatility, as we showed you earlier on a couple of different views, the VIX has popped up. Still could go higher, is my bet. And then if I got gold and silver, if the dollar's down, you'd expect gold to have a good day. And frankly, as I look at the various patterns in the market, that's the most bullish one I've seen you. kind of a funny looking cup and handle breakout, perhaps. Worst case, a flag and a breakout. If I look at silver, not as strong. Positive day though on Friday. And gold miners ultimately should do well if gold goes up, but they're sitting here still in kind of a consolidation pattern. Now, you think you're a great stock picker and a great trader? Well, here's an ETF of Innovator IBD 50, so an actively managed with what comes in and out of the IBD 50, and you could see that it sold off considerably this week and is now from its highs down about 4%. And then another thing you might want to look at is the momentum stock ETF, something I just added, and you could see the momentum stocks gap down on Friday and still above the 50-day moving average. So I look at this and I think it's pretty clear. The markets are stumbling. They haven't broken down. We haven't reached the point of no return. We could very easily have positive news come out that there's not a lot of new cases and the markets start to bounce. I'm not sure we're there yet. Now, if I look at industry groups and I hit my warehouse view and I go down to my number 2, Force Index 2-day up. Oh, I know it's not really 0. Come on. It never happens when I'm doing it for myself. So let's go up here. All right. 2-day up, 3 groups. I can't tell you the last time we had only 3 groups on a short-term positive momentum. 2-day down, 29 groups, including renewable energy, information, healthcare, applications, consumer finance, infrastructure, rail. A lot of the leaders of past have now rolled over. Now, as you get longer and longer bullish or bearish, we look at a 5-day. If I look at the 5-day up, I've got 5. And if I look at the 5-day down, I've got 81. So by far, this market is tilted to the downside. Sort of by design, since I usually buy contra ETFs and puts. I don't spend a lot of time looking at shorts on these calls, but if you feel like you know how to short and you're good at shorting, it's a good time to be shorting. Period. It's a good time to be shorting. But we'll see what the futures are Sunday. It might be a less good time. So I'm going to start with the 5-day longs, see if there's anything that pops up, because I think you'll see a pattern here. Precious metals and minings, change index group. Everything is below the index group. That is not a positive sign. If I look at some, hold on before I say that. No, here's some that are above it. Okay. Newmont Mining. We looked at this the last couple of weeks as well. Continues to look good. That's the view I want right here. Now, is it too extended for you? It is for me, so I'd be careful with that here. You can see it's bouncing up the top, but a nice uptrend. When do you want to buy these things? You want to buy these things down here when they're breaking above the moving averages. So Newmont Mining, we've talked about it several times. It's getting extended. Kinross Gold, a little bit less extended here. Off its highs, moving up. Franco-Nevada, I want to find periods like this where I've got the person buy signal, I have a pocket pivot, I have a kahuna, mobile breakout from a squeeze all at the same time, and a PSAR reversal and buying it off of the major moving averages in a squeeze. That's my trade I look for every day. I don't really care what the name of the stock is. Pan American Silver kind of pulling back here, setting up perhaps if the precious metals do well this week. Integrated medical devices were the top one here when I changed the order. Although interestingly, nothing is above the combo. Go look at the 2-day up on medical devices. Same thing. We'll just look at them very quick. Silk Road Medical, moving already. Extended, I probably would not chase it. Myomo, that looks like a takeout or something, unless it has something to do with coronavirus. Let's go info from the web. FinViz, what happened with this stock? Uh, 1 for 30 reverse split never is a good thing. That's probably why this group is up there. Alpha Tech Holdings. So I don't like this group. It came up to the top, so it's considered good because everything else is so bad. But as I look at it, I don't see a whole lot that make me want to start playing with it. Integrated utilities, you know how great you are when utilities are coming up to the top. Again, is this where you want to be buying it? Same pattern. Kahunas, person buy, mobile breakout from a squeeze. Wouldn't it be nice if you had a scan that would give you those? You will if you buy the add-on. Nextera Energy. These guys all run. AEP, Duke. Hard to buy these things. They're good to buy when they're breaking out. They've already run, so not that exciting. Investment companies. KKR stimulated some interest because they're talking about potentially getting listed in the S&P 500. So this here is Bitcoin Investment Trust. Well, I'm not a Bitcoin fan, and good thing my son's not going to listen to this. If I was a bit interested in Bitcoin, this break above the 200-day moving average here, a pullback, tail, and hold at the 200-day moving average. If this thing starts to move up from here, especially if we get a kahuna or something, this actually looks interesting. Sideways move and a breakout here. This is Kene Holdings. You know what they do. They are equity holding company. Do you get the idea that if we're finding groups that we never look at and stocks we never heard of, that the things that we normally buy have rotated out? I do. This is agricultural chemicals. It's kind of a sideways move in an IPO. Not tight. Downtrend. I don't see anything I like. So when I did my top-down review earlier today, I did it on the short-term movers, and I found some gold stocks I liked, but not a whole lot of things. Then I did my top-down review, my bottoms-up review, where I started with a list of over 500 stocks, and let me kind of show you where I ended up on the shorts and the longs. So on the long side, I actually could find 50 stocks that were interested, or I guess, hold on a second. I thought it was 50. Let's go down to this. I guess not. Oh, because there's a lot of ETFs. Let's just go to default view. Go to no filter. See, there are 37 stocks because of the ETFs. Let me punch through these very quickly. Dexcon, if you want to play the long side, at your own risk, look at the earnings per share growth coming in here. Medical device, tried breaking out on Friday, came back in with the market still closed up. Anything that was up on Friday was interesting. Selecta Biosciences is a cheapy stock. Why did I like it? Because I got a mobile breakout from a squeeze, a person buying a kahuna. Have no idea what they do. I don't care what they do, but that's my buy signal right there. Kinross Gold we looked at already. Molecular templates, it's in a hot area. The word molecular right now in oncology is big. It's got a weekly high close doji. Yes, that's part of the add-on. Mobile breakout from a squeeze and a kahuna, and a breakout from a high base. Certainly not without its risk. It doesn't have any revenue to speak of. It's in a hot area, and that's why I chose it. KKR, I mentioned, talk about indexes. And you got a kahuna, come back. You have a kahuna, pocket pivot, John signal, breakout here, mobile breakout from a squeeze and a viable gap up. Pays a 1.6% dividend. Has really been doing well. I've got some of this, so I'm happy. But I think it's up on news more than anything else. Cassava Biosciences, why did I like this? Because it's pulled back. It's now stabilized, consolidated, going into a squeeze, and I want to watch it and consider taking it if it breaks out from there. AEM is a nickel, silver, and gold mining company sitting right off the 50, mobile breakout from a squeeze. Probably look for it to clear this level in here, but I put it on a watch list. That's what this is. Pan American Silver, again, I need it to clear, but it's on a watch list. Camden Property Trust is one of the REITs that showed up, trying to break out here in a bad ticker, weekly high close doji, 2.8% dividend, great earnings per share growth. American Barrick Gold, not breaking out as of yet. I put it on a watch list. If gold breaks out, it's got good fundamentals. Charter Communications, it's hard for me to buy this. It's an expensive stock, expensive options, but look what had happened on Friday. It broke out of a mobile breakout squeeze with a new person buy signal, a pocket pivot, and a kahuna. It's expensive stock. It's going higher. This isn't a bad tape, folks. Wheat and silver, another precious metal. In case they break out, I want to have a nice shopping list. Don't know anything about Reata Pharma. For all I know, it's under a takeout, so let's look at that. Okay, it's not a takeout. It's about data on their drug. It's an expensive drug. I'd have to know a lot, or product a lot more, but look what you have. You have a base with a squeeze, a mobile breakout, a Bible gap up, a person buy, a pocket pivot, and a kahuna. The constellation of signals that typically leads to big winners for me. Arena Pharma has a drug that's positive data, waiting for the FDA, pulling back out of a flag. I have ways that I manage my flags. I don't buy this today because it went up a little bit, but what I typically have is a line. And when you break above that line, I'm interested. Until then, it's just something to have on a watch list. Enphase, solar renewable energy company, pulled back into the 17-day moving average. A little weak on Friday, but I want it on a watch list in case it turns around. Twist, nothing there. This has been a big winner for me, AYX. A little weakness on Friday. Look at the EPS for this next quarter. Because of that, I've left my position on. I'm going to continue to follow it. Chemocentrics, again, I want to look at it, make sure it's not a buyout, but it looks like it's getting ready to run. It pulled into its 17-day moving average. OMI, why did I like this? I know there's a reason. 7% dividend, consumer finance. You're not going to see big stock movement in there. Ruhan Holdings, IPOs, people have their own rules, but I got a mobile breakout from a squeeze and a kahuna and a stock that's about to break out that also had a high close doji. Here's another cheap biotech that seems to be breaking out. These biotechs, these cheapies are risky. I keep a couple in my portfolio and sometimes get lucky, aka Exosome, but a lot of times they do nothing. Talk about tight leaders. This is Copart, There were a couple other auto part companies that looked interesting as well. I'm already long it, so I wouldn't be adding to it. Don't know anything about Liberty Broadband C, but it pulled back into the 50 and broke out of a mobile breakout squeeze. Person, Pocket Pivot, Kahuna. Good earnings coming into the next quarter. This was a bottom play, Virtue Financial, with the high frequency firms and a it's one of the market operation companies. Why am I interested? I had 3 Kahunas out of 5 days, a pocket pivot, person buy sell out of a mobile breakout from a squeeze, and it pays a 5.8% dividend. A lot of reasons. Seemed to have stopped falling. Apollo Global, like KKR, another money manager, this one pays 4.3. I wouldn't touch it here, but the fact it's pulled back to free parking, I want to see what it does. By putting it in a watch list, I'll continue to watch it. Amazon is by far my biggest position, and what I want to show you is why was I still in Amazon? First thing is, I've been doing a lot of selling calls against it to reduce my cost basis, and I buy puts and put spreads when it's going down. So I made money on Amazon last year and the year before, even though the stock didn't do anything. Is this a big cup and handle, and is it breaking out? Maybe. How about, again, this may fail, but we are also at a triple top. Now, eventually it's going to break out of this. It traded above it, closed within it, but I'm going to be watching Amazon. My guess is, and let's go back to the daily chart. This, and somebody else said it on the web, I don't see this as a gap and crap. I think Amazon, because those earnings were so strong and you had several $2,600 things come up, I'm expecting Amazon to go higher. Obviously, if the market struggles, Amazon's not going to just go on without it, without earnings behind it. EPRT, here's a Really Trust 3.2% dividend. Kind of like the pattern it's forming here. It's not too far extended yet. Gaming and Leisure, another REIT, 5.8% dividend. Aident was that other auto parts, think of Copart. Why would I buy this? Bible gap up, mobile breakout from a squeeze, person indicator, and 2 Kahunas in a row, including a big one. I find that interesting, something to look at. TradeWeb Markets is an IPO, pull back into the 50 and mobile breakout squeeze, person, pocket pivot, Kahuna, 2 Kahunas in a row. Neoleukin Therapeutics, again, another high-risk small biotech, doesn't make money. Kind of looks like it wants to break out here on a watch list. Flextronics, just to watch. It failed its Bible gap up. I want to see what happens. Smartsheet, one that I've been in and out of. Kind of a move up along its 200. Looks like it's moving up from there. Something to watch, not to buy. A IPO that's way too far extended for my taste, Bill.com, something to watch, maybe buy later. Mortgage-backed bond, if I want to park my money, 3.2% dividend, 25.30 to 26.40, you've got a dollar delta over the last year. So you pretty much have a fairly safe instrument that goes sideways and it'll give you a 3% plus dividend. And this one gives you a 6.375 dividend, very little trade. And my only interest in it was the 6.375 dividend on a REIT. Believe me, if the dividends continue, if the interest rates continue to drop, these dividend players are going to become very attractive. And then for those that are interested in shorting, how about shorting the Qs? By buying the ultra short, which means this goes up when the Qs go down. You had a buy signal, pocket pivot, Kahuna, mobile breakout, not in a squeeze. And that was my list on the long side. I, again, do not do a lot of shorting, but I put together a short watch list which I will watch to see a tenor of what the market's doing. Credit acceptance, why? Sideways move, breakdown here, new person sell signal. It came back up on Friday, so that's actually good because I'd rather support it on a breakdown of this line and that support. But just watching. Lululemon, it's in a big, heavy uptrend. Mobo breakdown from a squeeze, pocket pivot to the downside, and a negative kahuna. Watching to see if it breaks down. I might buy it if it broke down below the 50, retested and failed, or I might short it rather. Amgen, Eureka's our baby out with the bathwater signals. This thing's in a world of hurt, breaking down. Illinois Toolworks, sideways, resolving to the downside again. Mobile breakdown, pocket pivot downside, kahuna to the downside. It's had a person buy signal on Thursday, so obviously just careful. Here's a weak-looking automotive stock. I'd want to see it break down below the 200. Thermo Scientific Fisher breaking down below the 50, tried to rally on Friday and failed. This is one that I potentially would be interested in shorting. SIVB Financial broke down, failed at the 50. ISO failure, maybe it's going to drop down to the 200. So I'm looking for stocks that are starting to roll over. United Health is rolling over. Align Technology has been the one I made money to the downside before. It's sitting here in near-term short support. A breakdown below the 200. A retest to the summer 19 lows would not be out of the question. Humana, just like United, clearly breaking down. They have earnings this week, I believe, and booking has broke down as well. So there's a number of things here. ASML, leading semiconductor, breaking down. So there's a lot of things breaking down in the market, and I'll be watching these because if they all start bouncing, that's going to tell me something about this market. Honeywell, Sherwin-Williams, big stud of late, but look at the group turning down and how the stock broke down here in a big low close doji over there. It looks like a low close doji. I don't know why it's not a low close doji. On the weekly. Cognizant Tech, failing at the 200. It's been a good place to short. It's got failed at the 200 here. Going through these quickly, I'm about done. Breakdown on Linda PLC on both the daily and the weekly. Specialty chemicals, the mid caps breaking down, mid cap ETF. So again, what I do with these, and I say this every week, and I'll just say it one more time before I say goodbye. I'll put these into a trade station where I have my Q, which are from Cigars, Superior Profit, some of my own HGSI related screens, pocket pivots, Bible gap ups, earnings dates, and then a bunch of John Person indicators. And then I'll set alerts, and it'll be running in the background during the day, and I'll take trades when they pop up as long as I'm at my desk. I hope this helps you. I guess what are my messages? Be careful. This thing could get worse before it gets better. Don't negate the positive possibilities down the road, though. Watch your money. Raising cash is never a bad thing, and we'll see you next week. Sometime in the next 7 days, you will see something coming out from George, John, and I about the add-on, my scheduled introductory webinars, and whether or not John will be participating with those. Goodbye, everybody.